There are so many stages, it's crazy.
Yes, there are so many. I think we are live now.
Brilliant.
I'm just gonna check if it's streaming. 1 second. Yeah, I think we are. Hi, everyone. Welcome to the session. We have Isabella Ghassemi-Smith, the ecosystem manager at Seedlegals, and she will be talking to us about the legals of getting investment and funding. So, Isabella, I will leave the stage to you.
Thank you very much.
Thank
you. Cool. So for anyone that isn't sure what today is about, today is everything to do with getting investment ready and getting funded. Just to make sure, can you see the purple screen? Hopefully, yes. Ideally, you will. And effectively, what we're going through today is a really broad spectrum of all the preliminary stuff you need to protect yourself as a founder, as well as how to actually get your idea, I suppose, investment ready so that other people get why it's so amazing, through to actually receiving that investment and what you should know about. And then, of course, when that money is in the bank, what in the world are you meant to do with it? So we work with over 16,000 founders and we have a huge amount of data. And even so, like when startups come to us, we go back to the basics, right? Which is, have you protected yourself as a founder? Because ultimately, being a startup entrepreneur is really a lot harder than you think it is. And a lot of the time, 10% of founders split up and people do leave because it's tough. And the problem with that is that if I own 50% of the business and you own 50% of the business and you leave, and you're not bringing in any new clients, any new capital, any new investment, then half the business is uninvestable effectively, right? And so the first thing you need to have in place is a founders agreement outlining your rights and responsibilities to the business, but more importantly, to put in place a share vesting schedule. So for anybody who doesn't know, a share vesting schedule is really quite simply the fact that I will get my shares up front, but I have to stay a specific amount of time with the company to be able to cash in on them. So if, for example, my share vesting schedule is 3 years, which is the average, and I leave after 1 year, then I would effectively have to give 2/3 of my shares back. Now, that is important not just to protect the business, but also because if I'm an investor and you're telling me that you and your co-founder are just going to have your shares and I'm meant to invest 50 grand in you with no guarantee that you're actually going to stay with the business, yeah, you'd be pulling my leg. And so investors normally, like if you come towards them without even having a share vesting schedule in place, they basically think two things. Either one, yeah, this business was cool, but clearly they're amateurs, so I'm really not that interested. Or, yeah, this business is cool, they're clearly amateurs, let me see what I can do here. And then they might impose on you, a 6-7 year vesting schedule, which is double the normal amount. So you want to really do it for 3 reasons. Protect yourself as a founder, don't look silly to your investors, and also so you can control the conversation with your investors. Now, the third thing I want to talk about along those lines is protecting yourself as a founder through protecting the business and its intellectual property. So intellectual property isn't patents, it's not your cure to cancer, it's very simply everything that makes up the ethos of the business. It's branding, it's content, anything along those lines. And a lot of the times I see founders say, oh yeah, like I had my friend build my website, he was going to give me mates rates. Now, the problem with that is that in 3 years, when your company is doing fantastically, it is possible, and I've seen it happen before, where that person or someone you've worked with in the past will come back towards you and say, hey, oddly enough, I'm really glad that you're doing super well with your business, but you don't actually own the IP rights to your website. I own them. Give me 3 grand and I'll assign them over to you. And it happens because you can't really predict what position people are going to be in 3 years from now. Some people get desperate. I mean, look at the world we're living in with lockdown. So it's really important to kind of prepare for the worst whilst you are at your best. And also because when investors do start getting interested in you as part of their due diligence, they're going to ask you, do you own all of your IP? And it just is a lot of work to, so long down the line, go and try and find everyone who's ever contributed something to your business and say, can you sign an IP assignment? Can you sign an IP assignment? So really, I think just get on top of the admin, seem more professional, then maybe potentially you are, and have all the paperwork in place. It's so crucial. So once you've protected yourself as a founder, this is in particular relevant to UK founders, but also these are schemes that I think are present internationally. You want to secure all the kind of tax benefits startups get. And in the UK, that is SEIS and EIS Advanced Assurance, whereby you can take up to 150K of SEIS funds where your investors get a 50% tax break on their investment, or alternatively, take up to £12 million of EIS funds where your investors get a 30% tax break. Now, I couldn't necessarily tell you which ones are around everywhere, but certainly look into it. In the UK, at least 90% of all early stage investment is funneled through SEIS and EIS funds, basically meaning that if you're not kind of offering these benefits to your investors, you're quite unlikely to raise capital. Lovely stuff. So this is not particularly important. It's just to let you know that you shouldn't get bogged down in the details. So then we move on to the question of, well, we've protected ourselves as a founder and we have kind of some of the bits and pieces in place, but how do we value our business? And again, I couldn't tell you. I think it's a really complicated question, but I do have a lot of data. And what that data basically says that on average, founders raise every kind of 12 to 18 months. You know, it's like kind of go big or go home. You're going to raise loads of cash and you're going to give away lots of equity. And the question is how much equity are founders giving away in that process? So from all the data that we have, on average, it's about 15%. And the reason that that's important is quite obvious. So I'm going to tell you a little story, and that story is of the company Buffer, obviously the social media scheduling platform. Now, back in the day, they actually got a lot of interest, right? And an investor came to them and said, hey, I'll give you 100 grand for 30% of the business. Now, initially, they both thought, this is great. We can build all these products. We can hire a marketing team. We can hire these people. This is fantastic. But very quickly, one of the founders was like, whoa, we don't even know like if people want what we're building. And so instead, they created a landing page basically saying, this is us. This is what we do. If you're interested, sign up. And then once they got a lot of emails, they then released a second landing page saying, hey, this is us. This is what we do. Do you want to sign up? And do you want to pay for it? And people did. Now, the reason that story is important is because if they had given that 30% upfront to that investor, it actually would have massively restricted them down the line. The reason being is if you give 30% to an investor in your first round, right, what are you going to give in your second round? Are you going to give 10%? Are you going to give 15%? Let's say you give 10%. Okay, so you've given away 40% of the business. What about your third round? How much are you going to give? I don't know, maybe 10%, maybe 5%. Okay, something along those lines. So pretty much in 3 rounds, and probably you've raised maybe $1 million, you've given away half the business. I'll tell you very clearly, VCs, institutional funds, they are going to need you to have more skin in the game to invest in you, because by this point you have diluted yourself so much as a founder that they're kind of like, do you even have any interest left? And also they don't really have enough equity left to come in on, right? And so, yeah, so you want to really be careful about the amount of equity you're giving away. It's not to say you have to give away 15%. You can obviously give away like 1 or 2, that's great. Or you can give away, 15 to 20, but just be aware of how much you're giving away and what your plan is for the business, because a lot of founders make themselves uninvestable at a very early stage. Now, the reason that this whole conversation is important is because a lot of people are like, but I haven't generated any revenue. I don't have any numbers to talk about. How can I come to a valuation? And that's true, because ultimately it's just a lot of nonsense, right? Like you're going off of numbers that don't actually exist. So I think more importantly, maybe focus on a point that you will be able to generate those numbers, right? So how much equity you maximally looking to give away? Let's hypothetically say 15%. Well, how much money do you need to get to the next year, right? Do you need 100K? Do you need 150K? Does that give you a 3-month buffer in case everything goes wrong? Like, who do you need to hire? All these kind of things, I think right? And so it's very easy to say, okay, well, that sets a maximum threshold and a minimum threshold. We only want to give away 15%. So our valuation can't be super low to raise 100K, but it also can't be so high that we're going to overvalue the company and potentially go through a down round, right? As I said, I can't tell you how to value your company, but I can give you a little bit of insight on kind of where you can set your landmarks. All right, cool. So we're getting there. We've protected ourselves as founders, right? we have secured SEIS and EIS advanced assurance or any equivalent in your company. We've kind of got an idea of evaluation. We're doing well. Now we're talking to investors. So I think we're just going to talk about tricks of the trade, right? And one trick of the trade is certainty and consistency. And one way to achieve that is talking about a pre-money valuation. So what is a pre-money valuation? Well, effectively, if I was to say, I want to value my company at £1 million, that is my pre-money valuation. We've come up with that number. Whatever we've decided, that is our number. And we want to raise 250K. So our pre-money valuation is £1 million. Our post-money valuation is that million plus 250K, so 1.25 mil. Great. Now, why do we not talk about a post-money valuation? I'll explain very quickly. So let's say I'm the founder and you are all my investors. And I'm like, ladies and gentlemen, super excited to close this round. It's going to be great. Closing tomorrow, 1.25 mil valuation. Great. And then second lockdown hits, second wave of COVID. And one of you reaches out to me and says, Bella, I'm really sorry. I need to focus on my current portfolio. Now, the issue there is that I then have to email all of you and say, yeah, so funny situation, ladies and gentlemen, we're actually closing at a 1.2 mil valuation. Now, the reason that's annoying is because your investors are thinking, why has the valuation changed? Bear in mind, the valuation has not changed. The amount of money you've raised has changed. And then also you need to update all of your documents because this then changes everything, right? So I think just avoid that kind of uncertainty, because ultimately until that shareholders agreement is signed, you will not know whether an investor is going to invest, okay? Until the documents are signed, that money could be gone. And I think lockdown and Corona and this whole mental situation has been a perfect example of that. So save yourself that like uncertainty and go for a pre-money valuation because it's a fixed target. Another thing you should be thinking about is always having 2 pitch decks ready. Now, the reason being is you want your short deck, which is, this is us, this is what we do, this is how we do it, this is why we do it, right? This is our team. And then the longer deck, which is that, plus the financials, plus the revenue model, plus like the kind of real business details. Now, the reason you separate them, there are a few reasons. So if I'm a VC and I get in touch with you and I say, look, we love what you guys are doing, we really want to talk to you, why don't you come in, let's sign a term sheet, let's get this party going. You come in, you tell me everything, I'm like enthralled with what you're saying, and then you leave and then you don't hear from me. And then you drop me a really relaxed email saying, hey, like, you know, how's it going? Like, are we keen to move forward on this? And then I'll say, well, I'm really sorry, actually, we're going a different direction. And that different direction is actually investing in one of your competitors. So this is something that some people do, right? They'll do their due diligence by really, I think, you know, flattering your ego and coming and speaking to you. And I'm not saying that you should go and send NDAs to everyone. That's crazy. But I'm also saying, don't be stupid. Like, if someone's wanting to talk to you, maybe do some research. Like, if a VC is clearly invested or is looking at, or like you've heard conversations that they're going to invest in someone who's very similar to you, maybe ask yourself, oh, are they really that interested in what we're doing? Or alternatively, like, if it's a VC that doesn't really seem to invest in companies of your type, maybe look at their portfolio, only focus on the VCs that do. It's the same with angels, right? Like, ask founders that they've worked with how it was working with that angel, because I think that's just your easiest way of protecting yourself as a founder, and I think you have every right to. Another reason is because if you start sending your decks out to everyone and people are coming to different financial predictions on you guys and different valuations, and you have different valuations circling within a very small investor group, yeah, like, again, like if I'm coming to like a 3 mil valuation and someone else is coming to a 10 million valuation, both of us kind of have questions as to like, how did you get to that number and how did you get to that number? And finally, like if I'm an investor that actually really likes you guys and you just send me everything, all I'm thinking is like, how amateur do you have to be to do that? Like, this is confidential information, you've just sent me everything, who else have you sent it to, you know? So I just think, you know, be aware of those little things. I think play the more mature game, be a bit more patient, you know. Yeah, like, I think having 2 decks is a really easy way to go around that. And also having your decks like completely ready indicates to investors, like, if I am an investor and I'm really interested and you send me, like, when I ask for it, everything that's very important, all I'm thinking is, oh, like, why do they have this ready, you know? Who else is looking to invest in them, you know? suddenly it creates a sense of urgency, right? That I might be missing out on a really good deal. And that actually leads me to my next point, which is how are you actually meant to talk with your investors? And I think a really simple trick that not everyone uses, but it has worked quite well, is ask for advice before you ask for actual money, right? Like if I'm an investor and I'm getting like 20 decks a day, but you've done your research and you know I'm an expert in, for example, medtech, and you email me and you're like, hey, look, Bella, like I know you're a really senior expert on medtech. I have this business. It would be really cool if you could give me one bullet point, like one piece of advice on it. I'd massively appreciate it. And then I do. Maybe I won't, but if I do, I might be super harsh. I might tear you guys to shreds. Now, you might think that's a bad thing. That's actually a really good thing, because then in a month, you can email me and go, hey, remember that advice you gave us? Thank you so much. However, that assumption that you said that we made that wasn't right, actually it was wrong, and I can show you how through this. However, the other bit of advice you gave us, which was right, we used and it was great. And suddenly you're kind of building a relationship rather than doing the very casual thing of like, we're the best business ever, you should invest in us, right? Another really important thing when you are speaking to investors is like they want to be able to see that you're someone that can deal with tough situations. And I think lockdown is a perfect example of that. If you are going to people saying, yeah, we're a travel tech company, obviously we haven't done well this year, that's just not a good enough reason. Ultimately, you should be a product market fit at any point in your journey. And that doesn't mean that you're hitting the peak levels you'd normally hit, but it also doesn't mean you can do nothing, right? It's really about taking your strengths and applying them to the current situation. So for example, Seedlegals, where I work, is a legal tech company, right? And then lockdown happened, and then our kind of core business was slightly compromised because we work with startups looking to raise investment. So we thought to ourselves, okay, we're gonna have to change our product map. Let's think, what are we good at? We're good at legals and we're good at automation. What should we do? We automated legals. And so with all the kind of government papers that were coming out, like furlough and the future fund, we automated that and we got a huge exposure rate. And I think it really said a lot about the business. And your investors are hoping that you're going to be able to go through the good times and the bad times and not just be like, oh, it's so hard being a founder. Another thing is, when things got difficult, did you just sit back or did you immediately cut down on your burn rate and extend your runway? Because if you didn't, again, big red flags. Like, why did you not look at the financials as the first thing? Because, you know, taking one person off salary or cutting down on trying to renegotiate your office lease, right? That could give you another 2 or 3 months of runway, because the moment you're cash flow negative, you're cash flow negative. That's it, you're done. And so there's a lot of kind of tricks and tips like that. Okay, cool. And the last bit is make sure that you are modeling a investor's equity dilution correctly. A biggest pet peeve for investors is just this inability of founders to get the maths right. There's really no reason you should be using cap table automators. You really shouldn't be working off of an Excel spreadsheet unless that's actually your day job. Because yeah, in my head, it's like, if you can't get the financials right now, like, how are you gonna get them right, you know, at any point in this kind of journey? All right, cool. We're at the penultimate point, which is effectively actually raising investment. So fantastic. We've gone through all of those steps. We finally secured investors. We are in the investment process. Am I going to take you through every term that will come up in a term sheet? No. Am I going to tell you about the themes you should be aware of? Yeah, I am. Now, the first thing is with your share classes. A big mistake people make is creating legacy share classes to seem like they're important and they're complicated, but they're not. Meaning, you will see the alphabet share class of A shares, B shares, C shares, D shares, you know, all these different share classes. And for who? Who owns these shares? Probably no one. And the reason that that's difficult is because when you actually come to raise investment, there's a huge legacy of share classes that don't mean anything, and you actually have to undo them. So ultimately, when you're incorporating as a founder or as an early stage company, you're really going to want to have ordinary shares with voting rights, dividend rights, that kind of stuff. Then with your investors, they might get A ordinary shares depending on kind of what rights are within their share class. And then for your employees and your share options, you'd probably give them B ordinary shares with no voting rights, no dividends, and kind of no information rights, right? But they still get that benefit of the value of the shares. And I would really suggest only creating a share class when you actually have someone to give it to, right? The second point is governance, right? A lot of founders think, oh, that investor wants, you know, consent for these decisions, yeah, sure, whatever, let's give it to them. But you don't understand, like, if your investors have an over expansive decision-making power, it can slow down such important decisions for the company and become bottlenecks. And I think a perfect example of that is I was working with a company who had to get investor approval to join an accelerator, who had to get investor approval to allocate 30K of salary. Like, really small things that create bottleneck after bottleneck after bottleneck. Like, these things are important. Make sure you're thinking about your governance, right? The investor director that you have on your board, why are they on that board? Is it because they have the most money or because they know the most about the business, you know? And I think stuff like that, founders are like, oh, we'll just sort it out later. And it's like, no, there is no later. Like, once that right is on paper, like, that's it, it's there. You have to abide by it. And then, you know, just be aware of the legal clauses that are going to come up that investors expect you to know, like preemption, like drag along, like tag along, like good leave or bad leave, or all these things. Like, you have an entitlement to understand as a founder, and they're not difficult. They really are not. And if you don't know them and you get screwed over, well, then, you know, that's your problem, right? So know your rights, know the data behind them, know what's market standard, and then, you know, go from that. And I think the most easy way to do that is to lead with your own term sheet, right? Like, why are you walking into this negotiation expecting your investor to give you their legal terms? Like, no, they're investing in your business. You should be able to have your own term sheet. And for any UK company saying, yeah, but that's super expensive, well, it's actually not. And if you want me to tell you how, well, then I can. But yeah, it's not difficult. Cool. And then finally, the penultimate point is actually how funding has changed. So I spoke at the beginning about this purple curve of the big or go home, right? Funding cycle. And actually, that's not the case anymore. We've really moved into an era of kind of continuous funding. Now, that doesn't mean that founders spend their entire time fundraising. That's wrong. It means that founders have a more flexible ability to raise investment, meaning you are no longer constrained to, this is the time frame we're raising in, this is the investor group we're raising with. If they don't give us the money, then that is it. Like, no, we all know that investors can pull out right before a deal closes. Why is it that founders are not able to close their investment round and top it up with investors to fill out that missing fund? Like, why? And it wasn't a thing, and now it is. Now you are able, if you don't meet your target raise, to close that investment round and top it up later with investors coming in with the exact same deal terms and the same share price or a much higher share price into your deal. And that's not, oh, founders are now spending all of their time fundraising. That's completely wrong. They're just trying to fill out the cash that they didn't get before, and it's opportunistic. It's not like you're spending your entire time fundraising, but it just means that if you meet someone that's interested in the business, you can bring them on, which before you couldn't because it was stupid. Similarly, right, if at the moment you didn't expect lockdown to happen, right, and the value of your company is plummeted, right, and things are not going very well, but you still need bridge funding to get you to maybe next year when you want to raise investment, why would you go through a round? You would go through a down round. That would be the end of your business, right? And if you have investors that you've worked with before that are willing to give you that money to keep you going, you know, use a convertible loan note, use an advanced subscription agreement, right? Or in France, it's called a BSA. Like, there are so many tools that will allow you to raise investment now and decide the valuation later when maybe the company's doing well. And I think a lot of investors and VCs are like, oh no, but then the founders are spending all of their time raising investment, like it's so not conducive to the business. And it's like, no, that's not the case. It just gives them the option to, if things go really wrong, to actually raise capital rather than go cash flow negative. Like, why is that a bad thing? And so look at the graph, right? Like, this was only in 2019. This has actually increased in the last 6 months. In 2019, founders were raising 4 times as frequently, right? And giving away small bits of equity. So raising a bit of money ahead of their round, raising a bit after, and then going through a funding round. And it just means that you can be more opportunistic. You can wait for the investors you think will contribute to the business. You don't have to rush closing your round because some investors told you to. So really research it, like research continuous funding, research what is in your jurisdiction. It's so important, and it really could be the make or break of your business. And the only reason maybe some investors don't like it is, in my opinion, because they're archaic and they think that it messes with their financial planning. But really, like, if it's the difference between you bringing on a terrible investor because you're on a time frame and a really good one because you had a bit more flexibility, I don't know. It seems pretty obvious in my perspective. Now, finally, once you've raised investment, you're going to want to start giving equity to your team. There are really tax efficient ways of doing that. Share options often is the best way. In the UK, the EMI option scheme is the most brilliant way to do it. It's a fantastic way to incentivize top talent. It's a fantastic way to inspire further commitment to your existing team. I think share options are brilliant. If anyone wants to know more about them, please let me know. And then, yeah, finally, advisors, right? I think advisors is something that people get caught out with a lot. Like, you know, some senior guy from some corporate company will come to you and be like, yeah, I've had all this experience, you should really give me 5% in the business. And really the data doesn't say that at all. Like, most investors look, like, if your valuation is sub 1.5 mil, maybe it'll be 2.2%. That's the mean amount, right? So it should be less. And then if the valuation is more than 1.5 mil, immediately it's 1.6. So if any advisor is coming your way being like, I should have like 6% of the business, I don't know, like, they're coming in once a month. Like, surely they know that that's a huge amount of equity to give anyone. So just be aware, like, don't get strong-armed into giving away equity that doesn't really make sense. Yeah, so that's it. I am from Seedlegals, and for anyone who doesn't know that, we are the largest closer of funding rounds in the UK, and we are also operate in France. We basically let founders have all of their legals in place, manage their cap table, give equity to their team, and yeah, we've basically automated the process. So yeah, it was a pleasure. Does anybody have any questions?
Thank you so much, Isabella.
No worries.
Great insights. I'm going to see if we have any questions here. People were really excited about the topic in the chat, and they really liked the advice you gave, that they need to contact the investors to get advice first before asking for money. So that was a really good one. And then, if you know, because we're talking about startups without borders, so it will be some startups will be raising investments from investors who are not in their country, right?
Yeah.
So do you have like any advice for if they need to take care of specific things when it comes to legal, you know, because it's different from one country to another? Yeah,
so in details, things change per country ultimately, and those are just like how things are worded, or particularly the statutory requirements. So for example, Germany protects founders a lot more, the UK is a lot more hands-off. You have different protections in place foundationally, so it's certainly worth researching. But ultimately, like the fundamentals, like founders agreements, vesting schedules, the terms that I discussed in the term sheet and shareholders agreement, share classes, share options, all of that is pretty unilateral. And so I think no matter kind of what language it's in, you want to kind of have those foundations in place and definitely set in your mind, so that when you get onto that negotiating table, it's not really up for discussion, so that what is up for discussion is the kind of more detailed stuff. And I think in terms of informing yourself about the different countries and about different investors, I think a really important decision is effectively, you know, how much different the terms are from what the country you're basing in. But ultimately, if you're raising in your jurisdiction, the investor will be investing on the terms of your jurisdiction and not on the terms in his jurisdiction. So yeah, you just need to check if they're aware or willing to accommodate that. So if a French investor is investing in the UK, it would be on the British terms.
Yeah, right. And somebody's asking, when is it the best time to approach investors?
So this is something that I didn't really cover, but ultimately traction is the most important thing. And I think it's such a funny word, but effectively traction is not just revenue, it's really cumulative. It's your growth currently, it's not even your cumulative growth to date. So how many users are you gaining per month? How many partnerships do you have? What is your social media presence? If you're a B2B business, right, like what different businesses are you working with? Like, can you show growth, particularly in a time of pretty difficult growth? Because if you go to an investor before that and say, hey, I have this great idea, give me 50 grand to prove it to you, yeah, like nobody will invest in that, and anyone who will is probably not investing for the right reasons. So you want to be able to go and say, hey, okay, not only do we have an idea that people want, that's a given, we are growing X amount month on month on month. And then that's really where you have a strong negotiating power. And then somebody will say, well, oh, I can't do any of that without money. And like, that's not true, right? Buffer literally created 2 landing pages to generate so many users. Other companies that are in product will launch a social media campaign with mock-ups of the products, like write pictures of them. They haven't even built one model. And, you know, someone I think I was working with before got like 50,000 followers on Instagram just from pictures. And then with those 50,000 followers, they then went to their investor and said, hey, we have this many people who want to buy these bottles. Can you give us the cash to create them? If that makes sense. So it's a lot easier than you think it is.
Yeah. We have another question here. Do all types of businesses have to have an ESOP in place?
No, most do, just because ultimately when you raise cash, like you have money, but sometimes that's not enough to draw really good people to the business. Sometimes they want a piece of it, like it incentivizes them to work harder. So no, it's not a requirement, but a lot of people do have it. Another reason people have it in place is because generally if you have an ESOP in place, it predicts to investors that you're predicting growth. It's like, we already know we're going to grow because we have share options in place. So it's a bit of like a smoke and mirrors kind of thing that investors sometimes buy into.
Right. And the last question we have is, are the numbers you shared like globally or in Europe?
So they're actually UK based, but over 3 years of data. And considering kind of the most startup friendly location is, well, like the UK is one of those places. And relative to other numbers I've seen, it's pretty unilateral. Like generally fundraising looks very similar across the globe. So if you compare here to Silicon Valley, apart from the difference in valuations, because they value people much higher than the UK does, it's all fairly similar.
Okay. Thank you so much, Isabella.
Thank you so much.
We're really happy to have you here.
Thank you.
Have a good day.
Have a good day. Bye-bye, everyone.
Thank you. Bye-bye.